Since they are credit score driven, right? The lower the credit score, the less likely the loan's going to be approved. So conventional loans are probably the most utilized loan because about 50% of the loans in the country are done by conventional financing. The other 25 would be FHA or VA and a little bit of USDA. But 50% of the loans being done are conventional, which means they're using Fannie Mae and Freddie Mac guidelines. Those are the agencies that kind of write the rules for how lenders utilize and underwrite and approve these files that eventually get securitized and sold and traded in the secondary market. They're great loan programs. They allow for higher loan amounts, right? But they're not generally for first-time home buyers, even though there are some first-time home buyer programs and some first-time home buyer guidelines for them. But generally, these are for higher credit score borrowers, larger down payments credit score borrowers. They are credit score driven. So for the longest time, the minimum credit score was 620, right, to be eligible. But new update is now they've removed the minimum credit score requirement. So you don't have to have a 620 credit score to get a conventional loan anymore. But I will say, since they are credit score driven, right? The lower the credit score, the less likely the loan's going to be approved, and which means it's going to be harder to get the financing for your home loan. But I have seen some loans get approved with lower credit scores. The cool thing about conventional loans is that they look at both of the borrower's credit data, right? So if you don't have a 620 credit score and you're trying to do a conventional loan, and let's say your score's 600, if you have another person on the loan with you that's like 700, the average score is around 650. That might help you in the electronic approval because the lender's going to be looking at what your income, what your debts, what your credit look like, what your assets are. So I will say that because they are credit score driven, you can easily figure out, what the cost is going to be with that interest rate if you've ever heard of LLPAs or loan level pricing adjustments. If you Google it and look it up, they are costs that are pushed down onto the loan by the agencies based on your credit score, based on your loan to value, based on the number of units, based on the purpose of the loan. There's lots of factors that go into there. So obviously the lower the credit score, the higher the price, which normally means the more expensive the loan in the form of discount points or more expensive the loan in the form of interest rates. But there's a lot of great things about conventional loans, and let's talk about them. Conventional loans do have a 3% down payment, actually lower than FHA. Now, you generally need to be a first-time home buyer to do that, right? But it's a great option for somebody if they're tight on funds and they are in a loan amount that may be above FHA, or they need to use a conventional financing because of the guidelines. Property appraisals are a little bit more forgiving when they're looking at the asset. They're still looking at what they call minimum property requirements. Like, there can't be anything safety-wise wrong with the house or health-wise wrong with the house, but you don't even need the utilities on at the time of the appraisal for a conventional loan. That's a lot different than a government insured loan. So there's benefits on the collateral or the appraisal to go conventional. If you got really good credit scores, you might want to go conventional because you'll be rewarded in your interest rate, but you'll also be rewarded in your private mortgage insurance. So PMI, also known as MIP on a government loan, PMI is an additional fee that's part of your mortgage. It doesn't protect you as the buyer, it protects the lender. In the event of a future loss, like a foreclosure, the lender could file a claim with the insurance company, the mortgage insurance, and they get paid back a percentage of the losses that they incurred. That PMI is probably going to be pretty cheap, less expensive than on an FHA loan. So conventional loans have their benefit, because there's no minimum credit score. They do allow for no scores. So if you had a borrower that did have a score and a co-borrower that didn't, and you run the loan through the electronic approval system, if the borrower with a score is the primary wage earner, you're probably going to get an electronic approval, and you're going to be able to price that loan as the credit score for the borrower who has a score versus the one who doesn't. So that's a cool little trick on conventional because they don't have the same credit score requirements like a government loan. So with conventional financing, one of the main differences is the down payment requirement. You don't have to put 20% down. You can put 10 or 5 or 3, but when you do that, it brings in the need for the PMI. That PMI is not for the life of the loan. That PMI will eventually go away. Once you pay the loan down to 78% of the original note, that mortgage insurance will drop off. Plus, on a conventional loan, if you don't want to have your insurance and taxes, your escrow is part of your payment. If you put 20% down or that loan to value is at 80%, you can actually request from your lender not to have your insurance and taxes part of your payment. And you may ask, why would I do that? Well, for some people's income, it may fluctuate throughout the year. Maybe in the summer months, they make a really good income, and in the winter months, they don't make much at all. So it's hard to budget. It might be easier to have a lower required monthly payment knowing that you'll earn an income or come into some money later on in the year where you can pay your property insurance when it's required to be paid, or pay your homeowner's insurance when it comes to renew. So that's a pretty cool feature that conventional does, where you don't have to have your insurance and taxes part of the payment if you're going to put 20% down. We talked a little bit about down payment. Let's talk about income. Income has some flexibility. They allow the lender to make decisions about how they view the income. If the lender can defend themselves, if they get brought in front of mortgage court, and they made the right decision and can document how they did it, conventional will allow the lender to make exceptions to income sources that maybe haven't been earned for a full 2 years. They will allow people who get paid a variable income, let's say with overtime or bonus or commissions, who've earned it for at least a year but less than 2, to go ahead and consider that stable repayment income if there's other strong compensating factors in the file, like reserves, good credit scores, maybe some historical education or work history in that same line of work that documents that this income is likely to continue. With their assets, pretty easy on the assets as far as deposits and stuff. They're going to be looking for payroll deposits, of course, that document your income, but also non-payroll deposits. Those could be large deposits, but they don't have to be sourced if they're less than 50% of the monthly qualifying income. And qualifying income is how the lender documents it. Sometimes your qualified income may be less than what your actual income is, because there's an average taking place, or there's a calculation from tax returns and stuff that need to be looked at. And so your qualifying repayment income, if it's less than 50% of that, it doesn't have to be sourced, which is pretty cool. One of the great things I like about conventional loans is with their student loan debts, and how if the monthly payments are in an income-based repayment agreement, you can actually qualify with that lower payment, even if it's 0. If your qualified payment is 0, they can do it. So conventional has some flexibility. You just got to be with the right lender. People who are married in community property states typically have to qualify together on a government loan, but conventional, you can take one of the spouses off and remove the liabilities from that other person. So talking to the right lender with the right plan will help you decide if a conventional loan is a good fit for you.